The Sharpe ratio is a crucial metric in the share market which is used to evaluate the risk adjusted performance of an investment. In simple terms, it helps you understand how much excess returns you are receiving for the extra volatility, that is, the risk you have taken on, compared to a risk free investment. It is essentially a measure of return per unit of risk. Imagine you are considering two different investments. Both have delivered the same return, but one experienced more up and downs, that is, higher risk than the other. The Sharpe ratio helps you understand if the extra risk you took on is in the more volatile investment was actually worth the additional return. Put simply, the Sharpe ratio tells you how much additional return an investment has generated for each unit of additional risk it has taken relative to a risk free investment like a government bond or a fixed deposit. The value of the Sharpe ratio indicates the risk adjusted performance of the investment. A high Sharpe ratio suggests that the investment has generated more excess returns for each unit of risk taken. This is generally considered good as it indicates the investment has performed well relative to its risk. A low Sharpe ratio implies that the investment has generated less excess return per unit of risk. This suggests the investment might not be as attractive, especially when considered the risk involved. Zero Sharpe ratio means the investment's return is equal to the risk free rate. You could have achieved the same return without taking on any additional risk. Negative Sharpe ratio indicates that the investment's return is lower than the risk free rate. You took on risk and still performed worse than the risk free investment. Such investments are generally not considered desirable. Sharpe ratio is used to compare investments, evaluating a portfolio, and evaluating fund managers. The limitations of Sharpe ratios are that it is based on historical data and is not a guarantee of future performance. It assumes that all volatility, both upside and downside, is equally bad, whereas some investors might view upside volatility as an opportunity. Also, the choice of the risk free rate can influence the Sharpe ratio's outcome.